Welcome back to 7-Minute Options. Today I'm going to take a look at a backtest in Oracle that I've been working on for a little while now, and I've run this position quite a few times over the past year with considerable success. And Oracle is one of those underlyings, like it's a huge company. The stock doesn't really move all that much, so it's stable enough to run strangles, and I feel comfortable enough running a strangle in Oracle. It doesn't concern me as much as running a strangle in some of the smaller companies or meme stocks. Like I would never run a strangle in like Tesla or GME or AMC or anything like that, just because any kind of an earnings surprise or earnings or news whatever can destroy that position. But Oracle is big enough and it seems stable enough that I feel comfortable enough running strangles in this. And this setup looks like this: sell a call, 40 days to expiration at the 15 delta level, sell a put, 40 days to expiration at the 15 delta level. And you do this once a month. So right now I usually do it, let's say on the 8th of each month, just to give you roughly 40 days to expiration. It's whatever that monthly cycle calendar is, third Friday of every month or whatever, and you want to back 40 days up from that. So and again, the 40 doesn't have to be exactly 40. Like it can be 36, 43, whatever, and maybe you want to wait a little bit for the right entry. But roughly 40 days to expiration, you run it every single month, and you exit under two conditions. One is you reach your profit target of 50%, or you close after you've held it for 25 days, which would be roughly 15 days to expiration, let's say. And this is actually a surprisingly good setup. So over the past 5 years, this is 64 months, right? So 64 trades once a month for the past 64 months. You can see from January of 2016 until now. And over the last 5 years, this has an average expected value of $14, which is pretty good. It's like $14 a month, right? And the way that works out is as it does with most of these trades, is you get a lot of relatively small wins, and then boom, you get a big loss. A lot of small wins, big loss. You can see the green lines here represent your wins. The red lines indicate losses when something does happen and you get taken out. There's actually a way to look at these red lines, and we'll get to that in a second. What this back test can't do is it can't eliminate things like earnings trades, right? Like I would not put this strangle on if I know there's earnings in that cycle coming up. The back test can't really reduce this, so the back test runs this through earnings and non-earnings and things like that. So if you can, for example, not run this through earnings, and then you might have a better success. But even if you run it through earnings, even if this is a completely automated strategy, it actually has a positive expected value, right? That's because implied volatility is typically overpriced. If I look at the histogram, we have a lot of wins piling up. So again, most of the time you're winning, right? And your wins are something like 23 bucks, 30 bucks, 15 bucks. Once in a while when IV is higher, you might make 40, 45 bucks on this trade, and once in a while you'll be up in the $70 or $90 range. Again, that happened twice in 5 years where you collected more than 70 bucks. And once in a while you have losses, and those losses tend to be pretty big. We had a couple of big losses here, minus 180, minus 180. And yeah, that's the way this game is played. Is you got a lot of small losses and a lot of small wins and a few big losses. And look, the equity curve did surprisingly well even in the COVID crash, right? Yeah, every time you got one of these losses, it knocks you back a bit, but there's definitely a very strong positive trend line. That's your $14 average value, expected value. And even during the COVID crash, it didn't drop that much. Most of these simulations just tanked during the COVID crash then. But this one actually did surprisingly well. And that's because I think Oracle doesn't move a whole lot. It's a big company. It has consistent customers, consistent revenue, consistent profit margins. It is not working on something speculative. It's just basically out there doing its thing. And when you have a big consistent company, its price is not going to fluctuate as much as other companies. But yeah, so this is actually a good strategy. And the way this would look today is I open up Oracle. There you go. This was 44 days out. Now, I'm not going to put it on because we have earnings on June 15th. So I like to avoid display on earnings. I'm not a big fan of having a strangle through earnings. But if you have a much bigger portfolio, like, yeah, my portfolio was quite small. It's only about 18,000 bucks. And I'd rather not take a $500 or $1,000 loss on an earnings play gone bad, as can happen with a strangle. I lost $1,000 on a Stitch Fix earnings play earlier this year. That one burned me. But if you have a $100,000 portfolio and you got portfolio margin, you can easily do a strangle. I would be doing a strangle if my portfolio would be above 100K and I would have portfolio margin, because at that point your portfolio can handle a $1,000 loss and you don't really care too much about it. But looking at the setup again, there we go. So 40 days out, we go to the 15 delta. In this case, that would be this one here. And the 15 delta on this side, the closest we got there is the 17 delta, sure. And we would collect $118. Now, the reason why I don't want to sell it today, again, is because we got earnings coming up. And this is not going to lose a whole lot of time premium before earnings, and then it's going to lose a whole lot. But again, earnings are always a bit of a mixed bag. Right now it's trading at 80. Is it going to go, again, it's outside the expected move, but it's earnings. I'd rather not take that hit. Yes, because it's an undefined trade, you can always roll it out, month after month. The problem I have is right now the buying power is only 917, right? You only need $917 to put this on. You got a theta of 3.8, which is fantastic because, again, you're only paying like $250 a theta. That's fantastic. My personal goal is like $400, $500 a theta, so I'm getting a really good deal here, so I like it because of that. Actually, ORCL, you can see here, this would actually give me a negative, slightly negative SPY-weighted deltas, which would also help me move my portfolio back to the delta neutral position. So I like this. I would put this on. I would hit that button if I wouldn't have earnings here. The other thing is, because this is an undefined trade, the buying power is dynamic. So if there is a bit of an earnings surprise and all of a sudden you go down to the $70 range, for example, for a few days, the buying power required to maintain this position would increase. And so the only reason I'm not hitting that button is because it's earnings coming up. Otherwise, I would. I think next month I probably will do this. So that's it in a nutshell. Next month I will be putting this on. I like this position. It has worked well for me in the past. And yeah, ORCL is not, it's a great stock. It has these long positions where it goes sideways for a long time, sideways for a long time. There was a bit of an earnings surprise last time, which is another good reason to stay away from earnings. But look, it came right back, right? You know how like usually 10, 15 days after earnings, it comes back. You can see it reverted right to the mean. If I look at the position of right where it was before the big earnings surprise, it came right back. So this is a great stock to do these kind of strangles in. But my portfolio isn't big enough to do it through earnings, so I'm going to wait one more month. All right. Thanks very much.